There are three documents that millions of retirees have their name on right now. Not hidden documents, not complicated legal instruments, documents that feel completely normal, documents that feel responsible, documents that feel like exactly the right thing to do. And the IRS uses every single one of them to calculate how much of your retirement money they are entitled to take. I am not talking about your tax return. I'm not talking about anything you filled out at the IRS. I am talking about ordinary documents, the kind a bank hands you, the kind an attorney draws up, the kind a well-meaning family member suggests you sign. And right now in 2026, retirees who have their names on these three documents are paying thousands of dollars more in taxes every single year without ever understanding why. Because nobody explains the connection. Your financial advisor does not bring it up. Your estate attorney may not volunteer it. Your adult children certainly do not know it. The IRS does not send you a letter explaining that a document you signed years ago is quietly costing you money every April. They simply collect what the document entitles them to collect, and you keep paying it. By the end of this video, you're going to know exactly which three documents these are, precisely how the IRS uses each one against you, the real dollar cost hiding inside each one, and the specific legal alternative that protects you completely. None of this is complicated. None of it requires you to be a tax expert. It just requires someone to sit down with you and explain it plainly before it costs you another year of retirement income. That is what we are doing right now. Before I go any further, let me be clear about what this is and what it is not. I'm not a lawyer, I'm not a CPA, I'm not your financial advisor. Everything in this video is educational, drawn from publicly available IRS guidance, federal tax code, and estate planning information current to 2026. Your specific situation is your own. Always confirm these details with a qualified tax professional before making any changes to your documents or accounts. My name is Kevin, and this channel exists for one specific reason: to take the information that sits buried in IRS publications, fine print, and legal documents that nobody reads and bring it to you in plain English before it becomes a problem. Not after you have already paid the price, before. If that is useful to you, hit the subscribe button right now, because what I am about to show you is something most retirees will never hear from anyone they trust with their money. And I want you to hear it today. Let me tell you something that will frame everything we are about to cover. The IRS does not need you to make a mistake to take more of your money in retirement. It just needs you to have your name in the wrong place on the wrong document. That is it. No audit, no error, no penalty notice. Just a signature you made years ago, sitting quietly in a filing cabinet, doing exactly what the tax code says it should do, which is hand the IRS a larger share of your retirement income than you ever intended to give them. Here are the three documents. We are going to go through every single one. Number one, a joint bank account where you added an adult child's name for convenience. This is one of the most common things retirees do. Your son helps you manage your finances. Your daughter lives nearby and you want her to be able to handle things if something happens to you. So you walk into the bank, add their name to your account, and feel like you have just made a responsible, practical decision. And on the surface, it is practical. But here is what happens inside the tax code the moment that name goes on your account. That adult child is now a legal co-owner of every dollar in that account, not a helper, not a backup signer, a legal owner, and the IRS treats ownership very specifically. Here is the first problem: interest income. If your joint account earns interest, and in 2026, with current rates, savings accounts are earning between 4 and 5%, that interest is reported to the IRS on a 1099 INT in the primary account holder's name and social security number. That is usually you, which means that interest is added to your adjusted gross income every single year. And for retirees, adjusted gross income is not just a number on a tax form. It is the number the IRS uses to determine how much of your social security gets taxed. It is the number Medicare uses to calculate your Part B and Part D premiums. And it is the number that determines whether you lose senior deductions that phase out above certain income thresholds. Every dollar of interest income your joint account generates pushes that number higher. And the higher it goes, the more the IRS takes from everything else. But here's the second problem. And this is the one that almost nobody knows about until it is too late. When you add an adult child's name to your bank account, you may have just made a taxable gift. Under IRS rules, if you add someone to an account that already has money in it and they now have legal access to withdraw that money, the IRS can treat that as a completed gift of half the account value. In 2026, the annual gift tax exclusion is $18,000 per person. If your account holds $200,000 and you add your daughter's name, the IRS could consider you to have made a $100,000 gift. That is $82,000 above the annual exclusion. And while you likely will not owe gift tax immediately because of the lifetime exemption, it counts against your lifetime estate and gift tax exemption. Every dollar that counts against that exemption is a dollar your estate cannot pass to your heirs tax-free. And here's the third problem: Medicaid. If you ever need long-term care and apply for Medicaid to help cover nursing home costs, Medicaid looks back 5 years at your financial transactions. Adding an adult child to your account and allowing withdrawals during that 5-year window can be treated as a transfer of assets, which Medicaid can use to delay your eligibility. The account you set up for convenience, to make things easier, to feel prepared, can delay your access to care you need. I want you to meet Robert. Robert is 74 years old. He lives in Ohio. He is sharp, organized, and responsible. 3 years ago, he added his son Michael to his savings account. $180,000 in savings. Both names on the account. Robert earns $24,000 a year from Social Security and $14,000 from a small pension. Total income $38,000. His account earns 4.2% interest. That is $7,560 a year in interest income. That $7,560 gets added to Robert's adjusted gross income. His total is now $45,560. At that income level, 85% of his Social Security benefit becomes taxable. His provisional income calculation puts him firmly in the maximum taxation tier. The extra taxable Social Security alone costs Robert an additional $1,260 in federal tax every year. And because his adjusted gross income now exceeds $44,000, he has crossed into a Medicare ERMA threshold he was previously just below. His Part B premium increases by $69.90 per month. That is $838 per year. Robert added his son's name to make things convenient. It is costing him $2,098 every single year. He has no idea why his taxes keep creeping up. Nobody connected the dots. The solution is not to remove your child from your finances. The solution is a document called a durable power of attorney. A durable power of attorney gives your chosen person the legal authority to manage your finances, pay your bills, make banking decisions, and handle everything you would handle without putting their name on your accounts. They get all the access they need. You keep sole ownership of every dollar. The interest stays managed properly. The gift tax issue disappears. The Medicaid look-back issue disappears. And the IRS only sees what it should see. One conversation with an estate planning attorney. One document. Completely solves every problem the joint account creates. If this is already making sense, do me a quick favor and hit that like button right now. It genuinely helps push this video out to other retirees who are paying this exact cost right now without knowing why. And protecting them is the whole reason this channel exists. Number 2, a transfer on death deed on your home. Now I need you to pay close attention here, closer than anything else in this video, because this is the document that is spreading fastest through the retirement community right now. Financial websites recommend it. Legal self-help services sell it. Well-meaning friends suggest it. And it is quietly destroying one of the most powerful tax protections available to any retiree in America. Let me explain what a transfer on death deed is first. A transfer on death deed, sometimes called a beneficiary deed, is a document you file with your county that says when you die, your home automatically transfers to whoever you name on that deed. No probate, no delay, no court involvement. It sounds like an estate planning miracle. And for some situations, it is a perfectly appropriate tool. But for most retirees who own a home that has appreciated significantly, it is a quiet financial catastrophe that will cost their children tens of thousands of dollars. Here's why. When you die owning an asset, your heirs inherit it at its fair market value on the date of your death. This is called the stepped-up basis. It is written into Internal Revenue Code Section 1014. It means that decades of appreciation, the growth in your home's value since you bought it, is completely erased from the tax code. Your child does not inherit your original purchase price as the cost basis. They inherit the current value as the cost basis. If you bought your home in 1988 for $95,000 and it is worth $490,000 today, your child inherits with a basis of $490,000. If they sell it for $490,000, their capital gain is zero. Their federal tax is zero. $395,000 of appreciation that built up over 37 years. Gone from the tax code forever. That is the power of the stepped-up basis. And here's exactly how a transfer on death deed can accidentally destroy part of it. In most states, a transfer on death deed transfers the property at death, which does preserve the stepped-up basis. So far, so good. But here is where retirees run into serious trouble. Many retirees who use a transfer on death deed also add language or take additional steps that inadvertently trigger gift tax consequences or create partial ownership transfers during their lifetime. Some file the deed and then later decide to add the child as a co-owner now, thinking they are being extra careful. The moment they do that, they have made a lifetime transfer of partial interest. The partial interest does not get a stepped-up basis. That partial interest carries the original low-cost basis. and it gets taxed at capital gains rates when the child eventually sells. But the deeper problem with transfer on death deeds is not what they do wrong, it is what they fail to do. Let me introduce you to Carol and her daughter Lisa. Carol is 77. She bought her home in 1991 for $110,000. Today, it is worth $575,000. Carol filed a transfer on death deed naming Lisa as beneficiary 5 years ago. She felt organized. She felt like she had taken care of things. Carol passes away. Lisa inherits the home at its current value of $575,000. So far, the stepped-up basis works correctly. But here is what the transfer on death deed did not do. It did not protect Carol's home from Medicaid estate recovery. In 43 states, Medicaid has the right to recover costs from a deceased recipient's estate. And in many of those states, a transfer on death deed does not shield the home from that recovery claim. Carol spent her final 2 years in a nursing home. Medicaid covered $180,000 in costs. After Carol's death, the state filed a Medicaid estate recovery claim against the home. Lisa inherited a $575,000 home with a $180,000 claim against it. Nobody told Carol that her transfer on death deed left the home exposed. She thought she had protected it. The transfer on death deed transferred the home, but it did not protect it. The alternative that actually works is a properly structured irrevocable trust, or in some cases, a life estate deed reviewed by a qualified estate planning attorney who specifically understands Medicaid rules in your state. These tools can preserve the stepped-up basis, protect the home from Medicaid estate recovery, keep the home out of probate entirely, and give you clear control over what happens to the property. A transfer on death deed is a $50 document filed at the courthouse. Proper estate planning with a qualified attorney costs more. But when the asset being protected is worth $400,000 or $500,000 or more, the math is not complicated. Drop a number in the comments right now. What is your best guess for how much the average retiree loses because of improper estate documents? I read every single comment, and I will respond to as many as I can. Number 3, an annuity contract where the wrong person is listed as owner. This one is different from the first two. This one does not involve your bank. It does not involve your home. It involves a retirement product that millions of seniors purchased specifically to protect their income. And it contains a single line, the ownership line, that the IRS uses to determine exactly how much of that money gets taxed, when it gets taxed, and who gets the bill. Let me explain how annuity ownership works, because this is the part that trips up even financially sophisticated retirees. An annuity contract has 3 potential roles: the owner, the annuitant, and the beneficiary. The owner controls the contract. The annuitant is the person whose life the contract is based on. The beneficiary receives the money when the annuitant dies. When you buy an annuity, the insurance agent typically lists you as both the owner and the annuitant. That is standard and usually correct. But here is where retirees make a costly mistake. Some retirees list their spouse as the owner in an attempt to simplify estate transfer. Some list a trust as the owner without understanding the tax consequences. Some list an adult child as co-owner, thinking it gives the child easier access later. And every one of those decisions triggers a different and often more expensive tax outcome. Here is the one that costs the most money. When a non-natural person, meaning a trust, a corporation, or certain types of legal entities, is listed as the owner of a non-qualified annuity, the IRS strips away the tax-deferred growth benefit entirely. The annuity loses its ability to grow tax-deferred. Every year of growth becomes immediately taxable as ordinary income. The entire reason most people buy an annuity in the first place, the tax-deferred compounding, disappears the moment the wrong entity is listed as owner. Let me show you what this costs in real numbers. Patricia is 68 years old. She purchased a non-qualified annuity 12 years ago with $200,000. The annuity has grown to $340,000. That is $140,000 in tax-deferred growth. Patricia wanted to simplify her estate, so her attorney suggested listing her living trust as the owner. The attorney was a qualified estate planning professional. But this particular tax consequence is one that slips past many attorneys who are not specifically tax-focused. The moment the trust became the owner, the IRS required the gain inside the annuity to be recognized and taxed. $140,000 of ordinary income. In 1 year, Patricia's adjusted gross income spiked from $48,000 to $188,000. Her capital gains rates increased. Her Social Security taxation jumped to the 85% tier. Her Medicare premiums triggered IRMA surcharges. She paid over $28,000 in taxes she would not have owed if the ownership line had simply stayed in her own name. One line on one document, $28,000. And there is a second problem with annuity ownership that affects surviving spouses specifically. when the annuity owner dies, if the beneficiary is anyone other than a surviving spouse, the entire remaining value of the annuity must be distributed and taxed within 5 years. That distribution is ordinary income. It is not capital gains. It is not stepped up. It is ordinary income taxed at whatever rate the beneficiary pays. If your adult child inherits a $300,000 annuity, they may owe $60,000 to $80,000 in federal and state income tax on money you saved over a lifetime. A spouse beneficiary gets different treatment. They can continue the contract and defer the tax, but a child beneficiary gets a tax bill. The solution here is a full review of your annuity contract with a fee-only financial advisor or a CPA who specializes in retirement accounts. You want to confirm that the ownership line lists you as an individual, not a trust, not a child, not a company. You want to confirm your beneficiary designations are current and reflect your actual wishes, and you want to understand the distribution rules that will apply to whoever you have named as beneficiary. This review costs a few $100s at most. The alternative is discovering the problem after the document has already done its damage. Now let me tie all three of these together, because once you see the pattern, you cannot unsee it. Every one of these documents was created with good intentions. The joint bank account, convenience and care for a parent. The transfer on death deed, simplicity and avoiding probate. The annuity ownership change, estate planning and family access. Every single one of them was a responsible, thoughtful decision made by a reasonable person who simply did not know what the tax code does to that document. And the IRS does not care about your intentions. The IRS cares about three things: your income, your ownership, and your basis. And each of these three documents quietly changed one of those three things in a way that costs you more money every year, or costs your family a fortune when you are gone. The criminals targeting retirees use fear to take your money fast. The tax code takes your money slowly, quietly, through documents that sit in a filing cabinet and look completely normal until the moment you or your family pays the price. Here is what I want you to do this week. 3 specific steps. Call your bank and ask whether any account you own has a co-owner who is not your spouse. If an adult child's name is on your account, ask your estate planning attorney about replacing that with a durable power of attorney instead. Pull out any property deed or transfer on death deed you have filed and have it reviewed by a qualified estate attorney with specific knowledge of Medicaid estate recovery rules in your state. Do not assume the document does everything you think it does. Locate your annuity contract or ask your insurance company to send you a copy and confirm who is listed as owner. If it is a trust, a child, or any entity other than you personally, talk to a fee-only financial advisor before making any changes, because changing annuity ownership can itself trigger a taxable event. 3 steps, 3 conversations. They cost very little. The cost of not having them can run into the tens of thousands. Let me ask you something directly, because your answer genuinely shapes what I make next. Before this video, did you know that adding an adult child's name to your bank account could affect your Medicare premiums? Type yes or no in the comments right now. And tell me which of these 3 documents you currently have. Just the number. 1, 2, 3, or all of them. I read every comment, and the most common answers tell me exactly what to cover in the next video. Now think about one person in your life right now. The parent who added a child to every account to be safe. The friend who filed a quick deed transfer they found online. The neighbor who changed their annuity ownership without realizing what it triggered. Picture their faces. Then send them this video today, before April. Before the next tax year adds another cost they cannot trace back to the document that caused it. Because that is exactly what this channel is here to do. Not to explain what went wrong after it is already too late. To warn you before it happens. If this video helped you, hit the like button and subscribe, so the next one finds you before the next tax trap does. I will see you in the next one. Stay safe and protect what you have spent a lifetime building.